If you're over 40 and still carrying student loan debt, you're not alone, and the good news is that meaningful forms of relief are available. Many midlife professionals find that refinancing their loans can significantly reduce the interest rate they're paying, lowering monthly costs and helping them redirect money toward savings, retirement, or other priorities. For qualified borrowers with solid credit and stable income, refinancing can make repayment far more manageable. Beyond refinancing, federal forgiveness options can provide even deeper relief. Programs like Public Service Loan Forgiveness, PSLF, can erase remaining balances after 10 years of qualifying employment and payments. Income-driven repayment, IDR, plans also offer forgiveness after a set number of years, aligning payments with your income rather than your loan size. These programs can be particularly valuable for borrowers in their 40s and 50s who are trying to reduce long-term financial burdens while still preparing for retirement. With total U.S. student loan debt exceeding $1.7 trillion, policymakers continue expanding and refining repayment and forgiveness pathways, including new improvements expected in 2025. In this video, we'll break down the most effective strategies midlife professionals can use to stabilize their finances, rebuild securely, and finally move past lingering student debt. Let's explore your relief options together.
Hi, welcome to SmartCents. In this channel, we talk about personal finance for mid-career professionals over 40. This is for people who think they've missed the financial bus. We're here to show you it's never too late to hop on and accelerate toward wealth.
Refinancing is the process of replacing one or more existing student loans with a brand new loan, usually at a lower interest rate. For borrowers over 40 who have steady, reliable income, this can be an effective way to reduce monthly payments and long-term interest costs. According to NerdWallet's 2025 analysis, refinancing can bring rates down to the 5 to 7% range, compared with typical 7 to 9% rates on many federal loans. That difference may seem small, but over years of repayment it can translate into substantial savings. Private lenders such as Sophie, Earnest, and Laurel Road commonly offer refinancing options. However, it's important to understand the trade-offs. Once you refinance a federal loan with a private lender, you permanently give up federal protections, such as income-driven repayment plans, deferment and forbearance options, and forgiveness programs like PSLF. For some borrowers, these benefits are valuable safeguards, so the decision requires careful thought. The financial upside can be significant. By lowering interest and shortening the repayment timeline, refinancing can save borrowers $10,000 or more over the life of the loan. There is a temporary drawback, though. The credit check required for refinancing may reduce your score by a few points. Most lenders also require a debt-to-income ratio below 50% to qualify. For midlife professionals, refinancing can accelerate payoff and free up cash that can be redirected toward retirement savings, investments, or emergency reserves, strengthening long-term financial stability. Student loan forgiveness programs can significantly reduce long-term financial pressure, especially for borrowers in their 40s who are trying to balance repayment with retirement planning. Federal Student Aid, FSA, confirms that Public Service Loan Forgiveness, PSLF, can completely erase remaining loan balances after 120 qualifying payments, provided you work in eligible government or nonprofit roles. This program is one of the fastest paths to forgiveness and is particularly valuable for midlife professionals committed to public service careers. For those outside public service, income-driven repayment, IDR, plans offer another form of structured relief. Plans such as the new SAVE program cap monthly payments at a percentage of your discretionary income, often around 10%, making the payment more manageable. After 20 to 25 years of consistent payments, any remaining balance is forgiven. This long-term path can provide predictability for borrowers with high loan amounts relative to income. Updated rules coming in 2025 are expected to broaden eligibility, adding more professions and expanding the types of payments that count toward forgiveness. A major benefit for midlife borrowers is the inclusion of retroactive credit, allowing certain past payments, forbearances, or deferments to count toward forgiveness progress. For working professionals, these evolving forgiveness avenues create meaningful opportunities to lighten debt loads and rebuild financial security. Refinancing your student loans can offer meaningful advantages, especially for borrowers in their 40s looking to improve cash flow and accelerate financial stability. One of the biggest benefits is the potential to secure a lower interest rate. According to credible, Many borrowers save around $200 per month after refinancing, depending on loan size and credit profile. Lower payments can free up money for retirement contributions, emergency savings, or paying down other high-interest debt. Refinancing also offers flexibility, with term options ranging from short, aggressive payoff schedules to longer plans that ease monthly pressure, allowing you to choose what best fits your budget. However, refinancing comes with important downsides. When you refinance federal loans with a private lender, you permanently give up federal protections such as deferment, forbearance, income-driven repayment plans, and forgiveness programs like PSLF. If your income becomes unstable, these safety nets won't be available. Additionally, choosing a variable rate refinance loan carries the risk of future rate increases, which can raise your monthly payment unexpectedly. Forbes notes that refinancing tends to work best for borrowers with private loans, strong credit, and higher earnings, those unlikely to need federal benefits. For midlife professionals, the decision requires careful evaluation to ensure refinancing supports, not jeopardizes, long-term financial stability. Understanding eligibility is essential to successfully navigating student loan forgiveness programs. Public Service Loan Forgiveness, PSLF, requires borrowers to work full-time in qualifying government or nonprofit roles and to hold direct loans enrolled in an eligible repayment plan. Each year of service counts toward the 120 qualifying payments needed for full forgiveness, making PSLF a powerful option for midlife professionals committed to public service careers. For those not in public service, income-driven repayment, IDR, plans offer another meaningful path. IDR programs require borrowers to verify their income annually so that monthly payments can be adjusted based on financial circumstances. After 20 to 25 years of qualifying payments, any remaining balance is forgiven. Renewing income verification on time is crucial to maintaining eligibility and preventing payment spikes. Both PSLF and IDR applications are handled through studentaid.gov, where borrowers can submit forms, check requirements, and track progress using the updated dashboard. According to KFF, millions of borrowers technically qualify for forgiveness but never pursue it, often due to confusion about requirements. Recent rule changes and retroactive payment credits mean many midlife borrowers may already be closer to forgiveness than they realize. For individuals in their 40s and beyond, these programs can eliminate remaining balances before retirement, easing financial pressure and strengthening long-term security. Refinancing becomes a smart move when current market interest rates fall below what you're already paying and you have strong credit that can qualify you for better terms. Borrowers with a solid credit score, steady income, and a history of on-time payments are most likely to secure the most competitive rates. Refinancing is also ideal for those who are ineligible for federal forgiveness programs, such as PSLF or certain income-driven repayment, IDR, options, since switching to a private lender removes access to those benefits permanently. However, it's important to understand when refinancing is not recommended. According to TICAs, borrowers actively enrolled in an IDR plan should avoid refinancing because doing so erases all progress toward future forgiveness. Even years of qualifying payments reset to zero once loans are moved to a private lender. This trade-off can cost borrowers tens of thousands in potential relief, especially for midlife professionals managing large balances. Before refinancing, take time to calculate your break-even point using reputable online tools that estimate how long it will take for the lower rate to offset any fees or changes in loan terms. Also confirm that your new loan has no prepayment penalties, giving you the freedom to pay it off faster without extra charges. With thoughtful planning, refinancing can support stronger long-term financial outcomes. Achieving long-term success with student loan strategy, especially in your 40s, starts with thorough comparison and planning. One of the most effective steps is to shop across multiple lenders before making any refinancing decision. Credible and similar marketplaces allow you to compare offers from 5 or more lenders at once, helping you identify the lowest interest rates, best repayment terms, and any potential fees. Taking this extra step can save thousands over the life of a loan. For federal borrowers exploring forgiveness, it's equally important to run detailed simulations using the Federal Student Aid (FSA) calculators. These tools show how different income-driven repayment, IDR, plans affect monthly payments, remaining balance, and estimated forgiveness timelines. Running multiple scenarios helps ensure you choose the plan that aligns with both your budget and long-term financial goals. Because debt decisions in midlife directly affect retirement readiness and taxes, meeting with a financial advisor can provide valuable clarity. Advisors can assess how refinancing or forgiveness impacts your retirement contributions, emergency savings, potential tax liabilities from forgiven balances, and overall net worth trajectory. For many people in their 40s, a hybrid strategy offers the best of both worlds. Keep federal loans eligible for forgiveness while refinancing private loans for lower rates. This balanced approach maximizes relief, protects benefits, and creates a confident, sustainable path toward financial stability. You now have clear student loan strategies designed to bring real relief in your 40s, so take action using the free guide link below. Many borrowers reduce their financial burden significantly by applying these steps. If you found this helpful, remember to like and subscribe for more guidance. Up next, we'll dive into smart mortgage management strategies to strengthen your financial foundation.